Hi guys, thanks for tuning in to another episode of Nuggets News. Today we've got a special guest, a bit of a legendary trader, I'm told, and I've followed your work recently. So welcome to the channel, Tony Sycamore from Tech FX Traders.
Thanks, Alex. Thanks for having me on the show.
I'm really looking forward to getting into your background. You've worked on Wall Street, at Goldman Sachs. You do the macro, which we love as well, and recently you sort of dipped your toe in the crypto world as well. So for those that haven't followed your work, what was your background and how'd you get into markets?
Oh, good question. I'll give you the short version because the long version can probably take about 10 or 15 minutes. But fresh out of uni, I was looking to get into the markets, always wanted to be involved in markets. And I ended up on a bond broking desk in Sydney. And one of the things about bond broking world was the sales people there were very active in entertaining clients, which meant generally going out to the pub 5 days a week. And I try and keep fit. It wasn't really a fit for what I like doing. I loved the market aspect of it, but I didn't really enjoy going out 5 days a week, because I was playing football and doing all sorts of things. So I took the opportunity to move down to the floor of the Sydney Futures Exchange in the mid-90s, and I got a job with Macquarie Bank as a trader and later as a broker on the floor of the Sydney Futures Exchange. And fantastic environment for a young person interested in markets to learn about the dynamics which drive markets. And I had a couple of good years there, but as probably a few of the listeners will know, the open outcry system, which was the process for trading futures contracts back then, was coming to an end. We had a move to electronic trading, and I didn't really know how that transition was going to work out in terms of my role at Macquarie Bank. They told me that they wanted to keep me, but one of the things that I was really interested in doing was doing my own trading. And I thought, well, here's a good opportunity to start trading on screens. I can take that knowledge which I've learnt from the floor and from my bond broking days and see how I go. And needless to say, it was a very interesting learning curve for the first 6 months. The trading was going beautifully, and I thought, right, this is the life, 2 or 3 years of doing this, and I'll be able to do this from anywhere in the world. It could be on a boat in the Caribbean, off an island in Italy or whatever. It didn't really matter. Yeah. But markets have a habit of teaching people that get a little bit arrogant or think they know more than they actually do, that they don't. And after about 6 months, I started giving back the profits which I'd made. And it brings me around to where I am today. I often tell the people that I teach to trade that making money isn't so hard. It's hanging on to that money. And this was a lesson I still remember very clearly. So bit by bit, month by month, I started giving back the profits which I'd made. And I was smart enough to realize at that stage that I didn't know quite as much as I thought I did. And I took the opportunity to join another bank, which was actually a stockbroking firm, an old Melbourne stockbroking firm called JB Weir, still around to this day. I think it's 160, 170 years old. It's gone through a few reincarnations, but I joined the retail futures desk there and was part of the retail futures desk and also part of the team which was trading a retail futures clients. And the retail futures fund did very, very well during the period before and also during the period that I was there. And about 3 or 4 years into my time at JB Weir, Goldman Sachs, the US behemoth, decided that they wanted to take a bigger presence in Australia. And the easiest way for them to do that was to buy or to partner with a well-established local brand. And hence it became Goldman Sachs JB Weir. And I guess cutting a long story short, one of the things they did, Goldman's ran their ruler through the business. They obviously wanted to keep the stockbroking network. They weren't so sure about the retail futures desk, and they certainly weren't sure about a couple of guys trading a retail futures fund, effectively for mums and dads who were trading retail futures for them and doing quite well. And I think they saw that and said, right, we're closing that whole gig down. The retail futures fund is no more. But Tony and Tony's boss, you're off to the proprietary trading room at Goldman Sachs. And if we were initially disappointed by that news, the fact that they were closing down the desk, you couldn't have imagined a bigger smile on a pair of traders' face to be told that they were going to work in the proprietary trading room of the biggest proprietary trading bank in the world. So it was a fantastic opportunity. And I guess that's the short version. I spent 6 years working there and had a fantastic time. Made some good money, learned a lot of things. The GFC came along and the world changed to what it is today. Proprietary trading as an occupation for people like me was effectively outlawed. Dodd-Frank and the Volcker rule prohibited proprietary trading by banks, and here I am today. So I went into an FX sales role at BNP Paribas, the Commonwealth Bank of Australia, and now I'm doing my thing for tech FX traders.
Yeah, so just quickly, what changed for people at home? How would you describe that those trading rules where people can't trade against their own clients and those rules that came about after the GFC?
Yeah, so I actually finished up at Goldman's on March the 6th, 2009. And for anyone familiar with that period, the low of the S&P, or the low of the global financial crisis, was March the 5th. And that was the low that the S&P traded to, a 666 low, which perhaps I should have had more foresight when I walked into the office that day and got called straight into the trading manager's office. But that was the end of my trading career, and I moved into a sales role there. But effectively what happened was all the bank prop traders, and all the banks did have prop traders prior to the change in rules, it meant that for anyone that wanted to be a trader, you had to have a big enough P&L to go off and work for a hedge fund, one of the big US hedge funds or a big Australian hedge fund. Or you had to become not a flow trader, but almost a transitional type trader, which meant you were managing the bank's flows. It might have been in FX, equities, could even have been in forwards and swaps. So you effectively trading the flows which the customers gave you. It wasn't a pure prop trading role. And that's still the world today. The prop trading firms are few and far between. You do see a few names pop up. They come and go. Big banks, if they are prop trading, it's generally a little bit more discreetly now. It might be in the treasury division or the balance sheet division, where they're also managing client flows. And of course, the hedge funds of the world are always in the lookout for good people. And unfortunately, my P&L at the time didn't justify one of those big hedge funds in off the US in Wall Street to actually sanction a move for me. So I changed my role. I became effectively a stockbroker, if you like, for foreign exchange clients, big institutional clients, could have been central banks, hedge funds, large corporates, you name it. We became a broker, if you like, for those people.
Okay, interesting. So your approach has always been a bit of the macro analysis as well as the technical analysis. I guess even your background, I've heard that you're right into martial arts or whatnot, but I think it's that interdisciplinary approach. And I know as a pharmacist going to the world of trading, you find that you look at things a little bit differently. Is that what you found is the sort of the best mix?
Yeah, I actually started purely as a technical trader, and that was by virtue of my time on the Sydney Futures Exchange. The first thing was Macquarie Bank had a really good technical analyst, and all the brokers would bring down their research each morning to talk to their clients. Their clients might have been in Singapore, London, New York. They could have been upstairs in an office in Sydney, but they would each morning put a call into the clients and say, listen, here's what our technical analyst view is for the day. And then after about an hour of making calls, they just rip that research up and throw it on the floor of the Sydney Futures Exchange. So it just became more of a mess on the floor there. And I found that there was a good opportunity for people that wanted to learn about trading, learn about technical analysis. So I'd go around, and a couple of good technical analysts there in banks, I'd pick their research up and start to read it. So for the first 5-6 years, I was very technically driven, and I found that I was able to make money by trading off charts, which was great because that's the idea of trading. But it wasn't until I really became part of the macro team at Goldman's that I got the full picture. And this is something which I think private traders miss, because yes, you will make money trading off charts, but there's other dynamics which we must take into account when we're trading. Now, my blend of trading techniques, I would say I'm still 70% technically driven, but I'm 30% fundamentally driven. And when I can marry those two pictures together, I get very strong trade biases and very good signals. And that's what I look to do now. If I've just got a strong technical view, for instance, at the moment, we've had a really good run in the Aussie, we've had a good run in the Euro, but I suggested taking profit to my subscribers and readers, saying, listen, good run, let's get out, take some profit. That was this time last week. Now, I haven't delved, even though there's some really nice, strong technical setups for me in the Aussie and the Euro. I think the Aussie and the Euro can go higher. It'd take a brave trader to actually wade into the market right now. We've got US GDP, we've got CPI in Australia, we've got non-farm payrolls, we've got ISM, we've got FOMC coming out. all this week. So in terms of, yes, we've got some strong technical setups, but our technical setups have to be validated by the fundamentals. And the way I see it, this week is almost like running the gauntlet through a very busy, street in Sydney.
Yeah.
Hopefully we don't get hit and get to the other side, but I'd prefer to get 3 or 4 lanes across the traffic, and then we can start to put the trades on that we like, if the setups are still there.
I was going to say, for the beginners at home, you've thrown a lot of acronyms at them there. So I was going to say, there's a lot of news coming out this week, and you'd be a brave man to get long the Aussie dollars. Is I guess the long and short of that.
That's correct.
Cool. I know personally, I'm the same. I've made a lot of mistakes trading, particularly crypto. I found really accelerates your learning. So I loved shares, and then I started trading some volatility and some futures. But once you get thrown in the Bitcoin market and watch it, rip up and then rip down and chew you up and spit you out, it really accelerates those learning lessons compared to people that maybe traded 20 years now and haven't seen. I guess the GFC, but it definitely fastens those cycles of learning. Would you agree with that?
I would. And the Bitcoin and the crypto market is I think, bringing a lot of new traders into the market. It's a new technology. It's much like internet stocks were in the late 90s, early 2000s. And it is attracting a lot of new traders, and it is a volatile market, which is great for traders because traders need volatility. Sometimes there can be too much volatility, and we have to be prepared for that, particularly in something like Bitcoin, which can sit dormant for 2-3 weeks, even 2-3 months, like it did at the beginning of the year, and just simply explode. And why I like Bitcoin, why I've been attracted to Bitcoin, is the FX market, which is where I've principally made my money and which I principally focus on for my subscribers, has largely been in a sideways trend for the better part of 10, 11 months. And as a trader sitting here trying to make money, we're constantly looking for opportunities. And when you see Bitcoin doing what it does, it's almost like a moth to a flame. I was interested in it. I certainly, when I was at CBA, we used to hear about how blockchain would revolutionize banking, but it was talked about more as a threat to the conventional banking system. It wasn't spoken about as a trading opportunity. And it wasn't until I got into the private trading world and started looking around, well, FX isn't moving, what else can I find, that I started to watch Bitcoin. But I won't go into something and just look and think, hey, this is moving, it's going up, it's going down, we've got to get the heck on that. I researched it, I found out all the facts and all the figures, and I guess established a knowledge base which would help me trade it. And I think, like we were chatting about earlier, I've only had 3 or 4 trades in Bitcoin in 2 years, but they've been really good trades and I've been really happy with them. I've just put on another trade in Bitcoin. I like the price action which we've seen this week post the comments from President Xi in China. It's, I think, probably only my 5th Bitcoin trade in 2 years, but I only trade it when I really like the technicals and I like the fundamentals. Right now I like the marriage which I'm seeing. Does that mean the trade's going to work? Who knows? We'll have to wait and see. But yes, it is a good volatile market. It is very technically driven. It's hard for us as traders to put a fundamental value on these cryptocurrencies. They're just, most of it's held by a very small minority of people, and it is largely used for speculation. And something which is driven by speculation like Bitcoin and the other cryptos is technical analysis is a wonderful tool for that, to trade it.
I definitely agree that these markets are, even watching the Chinese coins, explode, the Neos and that of the world, there's nothing necessarily that's changed for them. I don't think China's going to use any of these public chains, but this entire market is just dominated by speculating. One thing I do want to ask you about was, you mentioned that the blockchain, not Bitcoin narrative, and that was very apparent in 2013, 14, 15. Is that the time when you were hearing that?
Yeah, exactly. Yeah, it was still very much, we were sitting on the FX desk at CBA and we'd hear about the way blockchain would revolutionize not just our business, but the business of banking, cross-border transactions and all that type of thing. And at that point of time, we just weren't interested. FX was moving, he still hadn't even got to Brexit, which was June 2016, and that certainly provided lots of thrills and spills. But it was something which we heard of, but we took very little notice of. And credit to the people that picked up on it early. I mean, there's more and more people, you hear the stories, they got on at $200 or $50 and whatever. And I'm certainly not one of those. Don't claim to be, but it has caught my attention now, and it is going to revolutionize banking. I think that was the essence of what President Z said last week, that we have to embrace this blockchain technology. And what that does now is it puts a lot of pressure on global leaders who've spoken about banning or outlawing cryptocurrencies, because it is a threat to fiat currencies. It does put some pressure. No one wants to be left behind. When the Chinese talk about doing something like this, the Western leaders aren't going to want to be left behind. And I think that probably fundamentally supports the story which we just spoke about.
That's a very important point, something that, we're going to be talking about definitely more on the channel going forward. So the other thing I want to talk about now was the way that markets have changed. And I know you mentioned that crypto is dominated by traders, but I just get the feeling that even global markets these days are just dominated now by traders, if not algorithms. And value investing's kind of gone out the window a little bit. Does that worry you with what's going on and, these bots providing fake liquidity that's not really there? And if we start to turn down, is all this fake volume going to sort of step away? Does that stuff worry you? Or?
No, it doesn't, because it is a fact of life. The trading environment has changed. We have big data, we've got AI, we've got all of these different technologies coming into a space which has traditionally been the domain of humans.
Yeah.
But what we need to remember is it's still the emotions of humans which drive markets. It's that fear, that greed. They're always going to be the drivers of markets. Now, in my experience, these high frequency guys are generally very, very short term. There is longer term models, but what I'm seeing more and more from the returns, and it is hard to get a clear read on the returns from these sectors, is that a lot of them are simply replicating the trend following community. Yeah. And I don't think that's particularly unique. That's the longer term systematic type traders using AI. I think they're just replicating what many of the trend following community have already done. There is a few exceptions. You can probably go through and find out who they are. Renaissance is always ahead of the curve and that. But
even just quickly, I was going to say, I read an article the other day that said 90% of strategies are based off trend following. And again, that's something that kind of worries me. What if the trend changes? But anyway.
That's right. No, you're absolutely right. And that's something which the JP Morgans of the world are picking up. They're saying, well, okay, this AI technology, which is meant to be revolutionizing the market, their returns aren't really outperforming. So that's something we need to be aware of. Now, if we want to compete with these high frequency guys in the very short term, in a scalping sense, getting in and getting out within seconds, within minutes, we're not going to be able to compete with those guys. Yeah. We need to take a longer term picture, whether it's 2 hours, 2 days to 2 weeks. We need to move out of the space which is dominated by those high frequency guys. So that's the way I talk about it to the people who I speak to say, listen, don't try and compete with them in that space. It is high frequency. It is about having the quickest links to the exchanges, but not everybody, and this is the beauty of trading, there's more than one way to trade. We're not all going for 2 to 3 pips. Some of us are going for 20 to 30 pips, 200 to 300 pips. And that's fine. If a high frequency guy wants to sit in there and go for 200 to 300 pips, that's fine. The way I look at my trades, I'm trying to get in them for between 2 days and 2 weeks. And whether I get in for a pip more or less than where I should have because of a high frequency guy, it doesn't really bother me that much.
Yeah, that's super interesting you say that. I know a lot of people have got their longer term investment stocks, and I'm interested to hear your thoughts on this, and even Bitcoin as well. So people will have their Bitcoin that they hold for the long term, but then they like to trade around that. And I know for me personally, it tends to work best when we have big moves. If you're on the right side of them, get in and then get out of the market, so you're not asleep overnight when these big volatile moves happen and the whipsawing. Whereas when I was trading stocks and options, I found the only way that I was able to compete in the market was that sort of mid-term, selling options, that 30 to 45 day window where things tend to mean revert. When they have these big moves, it'll tend to, average out in equilibriums, I guess. So it's funny how different markets work differently.
Yeah, it is. And you're right. So there's two types of, there's not just two types, but you're talking about guys that do the buy and hold. And that I was... an article that I wrote for City Index this week, I was speaking about 2 weeks ago. I was at a barbecue for the quarterfinal of the England versus Australia rugby match, and at half time the conversation drifted to Bitcoin and what could possibly spur the next leg higher in Bitcoin. And I was talking to a mate who's in the real estate space. By virtue of markets, by virtue of that occupation, he likes things all market related. And he was, he bought into Bitcoin way before I'd ever traded it, and he's ridden it up to 20,000, down to 3,000, and back to where it is now. And he's not going to ever get out. He's holding Bitcoin for 100,000, whatever the blue sky objective is for these longer term traders are. Now, for me, I'm a trader. I'm not an investor. I do have some investment stocks which are in my superannuation fund, but I'm a terrible stock trader. I just put them in there if I like the story, if they're paying a good dividend yield, and we go from there. But for my active accounts, I'm a trader and I manage them actively. I'm scaling out as the trades run. Our objective is to make money, to lock some in, and I do want to be quite active in doing that. And it's not, some people tell you don't scale out of trades, but different horses, different courses. That's the way I trade.
Now, I've got a couple of requests from a few of our followers, and the first one was to talk about trading the FX markets, and the Aussie dollar had an enormous move. I remember this very clearly back in 2013. The Aussie dollar was $1.10, so it was actually stronger than the US dollar because at the time Bitcoin was around $50, but buying a Bitcoin in Australia only cost you $45, which to me was amazing back then. So what was it like trading the Aussie dollar, watching it go to $1.10, and then I think only, 2 years later or even a year later, it was down to the 60s, I believe.
Yeah, it's correct. I mean, I can go back to the GFC in 2000 and I remember actually trading for Goldman's and just buying some Aussie dollars because we thought the central banks would intervene later that evening because things were getting so bad, and bought some Aussie dollars because it should have benefited from rate cuts around the world. And literally I went to the bathroom and I came back 3 minutes later, and it was almost 3 cents lower. And it was, these big moves which you see are frightening. That was the time when Aussie got down to 60 cents. And then it rallied all the way up to 110.81, as you were saying. I think that was closer to 2011, 2010. But it's been a wild ride in terms of, if we step back and look at the Aussie dollar in a monthly time frame, there's been some big moves. Daily, not so much in terms of 2009. We've been in a downtrend, but it's been a slow, gradual grind. It has been very, very orderly. We haven't seen any of those big whipsaw moves apart from that one day in early January when we had the flash crash. The Aussie flashed down to 67.25. So there is big things like that to be aware of in FX. For me, it's just about managing and trying to control your risk. And I still go back to, and I think about this quite a lot when I'm trading, and it's very different the way the private trader world works. The private trader world is just thinking about how much money they can make from trading, whereas your professional traders are thinking about how much money I can lose on this trade, where's my stop loss, and the upside will look after itself. And for me, that's still one of the fundamental rules of trading. If you know where you're wrong, if you look after the downside, the upside will generally look after itself. And it's something which I got drilled into me at Goldman's, and I still talk about, I still remember it like it was yesterday, that meeting I had with my manager. He said, Tony, get a grip, look after the downside, and the upside will look after itself. And it stuck, and it should stick because it's good advice.
Yeah, that was probably one of the questions I had about your lessons, and I was hoping you would talk about risk management. And even good traders, they're never going to win 100% of the time. Even 50-50, you can lose more than 50%, but if you've got the right risk management and profit targets, it can still make you a very profitable trader. And I think in the world of crypto, where we've got this 100 times leverage, in some ways it's similar to the FX markets, because in FX, for people at home, you have such tiny moves that it's very common to use big leverage. Whereas in the crypto market, we've got this huge leverage, but we've got big moves. It's the double-edged sword.
Yes, it is. And leverage is a very topical point of conversation right now. We've had talk that ASIC will reduce the leverage from 400 to 1 to 40 to 1 or 20 to 1 or whatever it's going to be. And I am actually quite pleased with that, because I think 400 to 1 leverage is just astronomical. Even on Wall Street, the big banks don't really leverage up their $1 by more than $40. So whether they settle on 40 to 1 or 50 to 1 or 20 to 1, I don't think that's a bad thing, because the leverage which is available is frightening. Professionals don't touch that. So the way the professional traders work is they take lots and lots of little bets, and their win or their edge, which you just spoke about, is what makes them money. They're not in there and thinking, right, I just saw that house on the corner of my street get a for sale sign up on it, and I'm going to turn my $10,000 account into a whatever, and I'm going to buy that house at the end of this year. Professional traders are a lot more disciplined than that. And I think that's one of the big things which I try and talk to traders about. Listen, just have realistic expectations about what you're going to make. And it's not uncommon for me to hear people come and say, look, I want to make 1% a day. And I think, hang on, that's 300%, 350% a year. How? Like, when you think about the cash rate that you can get by putting money in the bank, it's 1%, but you want to go out there and make 360%. Show me an industry where you can make that type of money, and they don't exist. So I think it's really important for traders to have realistic expectations, try and make a little bit of money each day, look after that downside. If you're making 20, 30% a year, you're doing well. You're doing as well as some of the hedge funds in Wall Street. Forget about the 200s to 300%. It's not feasible.
And that's what I tell people. Something that helped me was thinking about who's on the other side of the screen. So whether it's, panicking when markets are red, if I'm pushing the sell button, who's that buyer who's buying when there's blood in the streets, and vice versa during euphoria periods. But as you say, if someone comes along and tells me they're going to make 1% a day or 10% a month, you're thinking, who on earth is going to be giving you all this money? Who are those 9, 10, 35 people on the other side of the screen who are planning on losing all this money to you?
Alex, if you know of anyone making 300% a year, let me know, because I'll give them some of my money. I mean, it just doesn't happen, not year in, year out. You might get lucky and you might double your account in a 3-month period. But for you to do that year in, year out, it's very, very hard. Now, of course, the volatility, which we spoke about in cryptos, and the leverage which you get, it is possible. But if you get that wrong, you're going to give back that money very, very quickly.
And that's an important point, because a lot of people did make 300%, but the percentage of people that kept that money, as you said at the start of the interview, would be maybe less than 3%. You've got to really, 97% of people have to lose for people to hold on to those gains.
Correct. And that's the big thing which gets lost. You hope that you're going to be one of those 3%, but statistically, to be one of those people, the chances are very, very small. So, it's just about chipping away. Crypto is a bit more of a speculative market. I think it attracts people with more risk appetite than other markets. So there is a tolerance for bigger drops, bigger declines and bigger profits. That's, I think, inherent in that market. But when we talk about trading professionally, if you lose 7 to 10% and you're working at one of the big hedge funds on Wall Street, you've lost your job. And that's what people don't really understand. They say, well, hang on, 7 to 10%, I've just watched my $10,000 account draw down $1,500, which is 15%. You think, well, that's great. I know you're only answerable to yourself. You don't have a trading manager. But if you were trading on Wall Street, you would have been told to pack your things and leave.
And just on that, with the GFC, and I know what's unfolding at the moment, I kind of get this feeling that a lot of these guys have made good money. They've accumulated good wealth. And as you said, they know how to hold on to it. So their actual exposure is never too high at any one point in terms of the individual traders. Do you think that who gets left holding the bag, I guess, is where I'm going with all this? Because a lot of these guys have made their money and they're going to be very comfortable even in another financial crisis. Is it the mums and dads and the super funds and all that get left holding the bag a little bit?
Yeah, I guess it depends for the time frame we're talking about. If we're talking about your traders on Wall Street, your hedge fund types, their attention span is 1 year, because at the end of that year they get paid their percentage of profits and they then start again. They've got a very different time frame to your mums and dads investors. For 30, 40, 50 years of age, we shouldn't really be too worried about, and I agree with this view, we shouldn't really be too worried about. End of last year, we had a 20% drawdown in stocks. It scared a lot of people out of the markets. But, here we are 10 months later and we're actually making new highs. So I think we have to look through that. But if you're a Wall Street trader and you've just taken a 20% loss, the odds are you wouldn't have taken a 20% loss, because you would have been stopped out by your trading manager long before it got to a 20% loss. But I think there is different time horizons. Everybody, as I said, is looking at different goals and objectives. And that's what makes trading, I think, very attractive to people as well. I don't think it just means that because Wall Street's made money, someone else has lost money. I mean, I know trading is a net zero game, but I think we need to think
Well,
about it in terms of time zones are different as well. Time frames are different.
just on that net zero, do you believe that the Fed and the liquidity they've pumped in has kind of made this not a net zero game? There's people that have been able to, capture that wealth, and we see it in inequality, maybe in asset prices rising. But do you think that a lot of that money's been pumped into Wall Street and hasn't made it to Main Street?
Yeah, I do. Yeah. I think that's what the statistics say as well, that if you've got a portfolio of real estate and a portfolio of stocks, you've done very, very well. That's without doubt a fact.
And zooming out with the macro view, I know we sort of think that, that 20% correction will ride it out long term. Do you think it is possible for maybe we've borrowed too much debt? In Australia, our government debt's not too bad, but in the rest of the world, the US and whatnot, is it a period where we could go Japan and go sideways for 20 or 30 years till growth catches up to these overvaluations and whatnot, or not in your mind?
It's I guess it's a little bit out of the space where I operate in. I mean, that's your bigger picture macro stuff that, I'm working in that 2-day to 2-week time horizon. But I think what we can say is there was a fear about that back in after the Trump tax cuts. The Trump tax cuts came around, and all of a sudden everybody was worried about the twin deficit, which was a trade deficit and government deficits, and they shunned the US dollar for 3 or 4 months. It eventually snapped back. But yes, it is a fear. But interest rates are low. The governments own these printing presses. We've got more and more acceptance of MMT theory.
Yes.
And again, that's something which isn't, I understand what it is, but I wouldn't want to speculate on whether it'll work or not. But I think people are getting more and more comfortable with the idea that if the debt of these sovereigns gets too large, they'll just simply turn on the printing press and helicopter money away. So, it's an interesting concept.
And I find it interesting because some people are focused 2 weeks to 2 months, as you say. What happens when things maybe do go sideways for a long period of time or maybe decline and you can short? But do you have any thoughts around just the political environment we're in with protests and civil unrest, the yellow vests, and people saying we're not going to allow the next round of QE? Do you think people are sort of waking up to these games? Because finance was boring. Like, even when I was at school, I had no interest in finance and economics.
Yep.
Whereas now I think it's really interesting. It's so topical for everyone. They want to know what's going on with interest rates and the banks and whatnot.
Yeah, I think there's a growing awakening about a number of things: environmental hazards, inequality in income, as we spoke about. It's certainly, I guess Hong Kong's a little bit different. It's more of a human rights issue. But it's interesting. Now, what will unsettle Wall Street? It's an interesting question. I think I think back to the Twin Towers, and we thought that changed the way the world would work. And it was 18 years ago, and the world's still plugging on. We've had all sorts of things through that, and we've had unrest in the Middle East, defaults, GFCs, and the world seems to keep bouncing back. And I think there's a common thread there, Alex. I really think that while we can manipulate interest rates and the price of money, they have almost the finger on the pulse of the controls. Now, if they lose control of that price of money, then that's when I think people really start to become unsettled. But right now, it's income's not going up, it's not really going down. Interest rates are low. I mean, we're looking at 3-year fixed here in Australia at 3%. I mean, in Norway and some of the Scandinavian countries, they'll actually pay you to go and borrow money to buy a new house. It's crazy.
We've spoken about this a lot on the channel, and I guess that's where I kind of think that, I used to be one of those people that thought the markets are going to crash one day and this is going to be bad. And then I became a bit more of a bull and more optimistic person, and it's served really well the recent years. But I kind of think, well, is all that, getting past the GFC and September 11 and all that, is that because we had the ability just to drop interest rates and allow that easy money, whereas now we are hitting that negative bound, and does that actually change things? So, yeah.
Yeah, it's an interesting question. I mean, that lower bound, are we there? And I think it's easy for people to put out the scaremongering. This is look at what's happening. Buy bonds, buy gold, buy US dollars, and maybe they'll be right. But it's a big picture story. And if I often wonder about the people that are doing that, and I think it often is purely to sell subscriptions and newsletters and that type of thing, because for them to actually trade those views, I mean, there's still people out there saying buy bonds, but interest rates are on the yields on 10-year interest rates went from 1.6% to 1.9% pretty much well in, as a 2 standard deviation move. How do you actually reconcile your P&L when you're seeing those types of moves, yet you're telling people buy gold, buy bonds, but we're getting this sort of intraday volatility? If it's just you with a very big slush fund sitting there, that's great. We can, like the guys that we saw in the Big Short, they were trading their own money. They could withstand those 40, 50% drawdowns. But geez, it's a tough one to sell to your average investor. If you've got your money in a fund and you see a 20, 30, 40, 50% drawdown, you're making calls and you're asking them what the heck's going on. So it is an interesting world.
Yeah, I was going to say a lot of people have far more subscribers than us that make videos saying that the world's going to end every year, and they've been dead wrong for 10 years.
Yeah, they have. And I was like you, Alex. I started the way I made a lot of money when I first started trading was by shorting stock indices, and it was during a good period of stock indices going down. Then all of a sudden I was looking at the DAX and the S&P grinding higher, thinking this is the high, I've got to sell it. And I actually walked into the office of my trading manager at Goldman's at the end of the year, and I said, John, I need to have a talk. And he said, what's up, Tony? I said, I need you to take my stock indice limits away. And he said, why? I said, because I keep selling them and the market keeps rallying, and I've analyzed where I'm making money and where I'm not making money. I'm losing money in the stock market because I'm always bearish and I'm always trying to sell it. In the FX market, I look at it with an objective set of eyes. I bring my macro in, I bring my technicals in, and I trade it without that emotional attachment to the market is going down. And he looked me in the eye and he said, Tony, he said, firstly, you're the first trader that I've known at Goldman Sachs here in Sydney to ever ask your limits to be taken away. He said, most of the traders here are asking for more risk, more products to trade. I said, that's cool, I get that. And he said, and I'm not going to do it. And I said, why? And he said, because you've got to learn self-discipline and you've got to learn to respect what the market's saying. And it was another fantastic lesson. Here I am being told, hey, if you want to keep making that same mistake, go for it. But you have to learn self-discipline. And I did. And I very rarely trade stock indices now. I stick to those FX spaces. I trade some gold, some oil, Bitcoin, as we mentioned. And there's enough going on in the FX world at the moment to keep me very happy. So that's where I focus my attention.
Fantastic. And I guess finally I want to ask you, I think you've got a funny story for us here with your Scottish mate who was short volatility, and volatility's been great to short for 10 years apart from a few occasions.
Yeah, I think I know who you're referring to there. Look, short vol, and short vol is described as picking up dollar bills in front of a bulldozer.
Yes.
8 out of 10 months, you're going to be able to pick those dollar bills up and get away with it. But when the proverbial tweet hits the fan, or just something else happens that's come from left field, then we do need to be aware that being short vol is a very dangerous game. And I have been a short vol trader. In fact, I haven't been a short vol trader for over 19 years. I feel reformed by saying that. But I used to short vol as part of the retail fund we had at JB Weir and made fantastic returns. But then a couple of things happened. The first thing that happened was planes flew into a building, September 11. Now, fortunately, and this is open to speculation, the equity markets had already started to sell off, which meant that we'd already been stopped out of that position before the planes actually flew into the building. So not a good result for the overall scheme of things, because a lot of people died. But for us, it was a bit of a, hey, listen, some of this stuff can get really, really unpredictable. And we thought, all right, well, we'll leave stock indices alone. And we went and started looking for other asset classes to sell vol in. And I found natural gas trading at 48% implied volatility, which was just absolutely phenomenal. And we were pretty good vol traders. And we ended up suffering through 2000, May 2000. I remember it clearly. So it was just before, it might have been May 2000. It was around 2001. Anyway, we sat through the equivalent being short vol of the 1987 stock market crash, except natural gas crashed higher. And that was it for us, right? We were done, no more selling volatility. And, I think the clients lost 10% of their funds at that particular time. It wasn't significant. And given how much they'd made, they were still not too stressed out about it. But it was, hey, listen, it's really hard to control your risk if you do want to be a short volatility trader. And it is a lesson there. Yes, you can sell vol, and in times like this where we've got low interest rates and the Fed and other central banks supporting liquidity, it's probably not a bad time. But even those wins do change. Like we saw December 2018, we have a 20% drawdown, and being short vol isn't a very good strategy at that time.
And I know you said it's interesting about how the markets had already started selling off. I know I've read stories about options activity around airline stocks with 9/11. Do you have any theories about that? Or
look, I think there was plenty of speculation that they bought downside in airline stocks, in stock indices, and without doubt, if you go back and look at the charts, equity markets were trading lower without too much apparent reason. And potentially, I don't think we're ever going to know the real truth there. But yes, that was true. There was a lot of speculation, and markets were trading lower.
Markets know all, I guess, the wisdom of the crowd. Well, I guess that's been fantastic conversation. I'll put the links to all your work below, Tony, but any final thoughts for people at home?
No, look, I think it's been wonderful chatting with you, Alex, and hopefully a few of the ideas and snippets which I've shared will help people with their trading career. It is about being disciplined and being focused, and it doesn't matter whether you're trading Bitcoin or you're trading the more conventional asset classes. Manage that risk, and the upside will look after itself.
Fantastic. We'll definitely have to get you back on soon.
Maybe love to come back on
once or twice a year if that's the only trade you're going to put on for Bitcoin. I'm sure they're going to be great trades.
Well, if this trade works out, you can have me back on in a month's time or something like that.
Fantastic. Great, mate. Thanks, guys.
Cheers. Thank you, Alex.